Independent economist Warren Hogan, who joins me now. Warren, always good to chat. A lot will be said about those new forecasts from the Reserve Bank, just where it sees the economy right now, as to what the prediction for future rate cuts is likely to be.
Yeah, that'll be key. They're going to be factoring, as markets are, a couple more rate cuts into their forecasts, and the way they've dealt with that is by what their core inflation forecast. So they had it at 2.6 previously, above the middle of the target band, that is 2.5, because they didn't agree with this market view that there was going to be 3 more rate cuts.
Sure.
That's sending a signal of caution. So what do they do tomorrow? They'll cut tomorrow. They'll have the cash rate at 3.6. They'll be factoring in another 2 rate cuts after that to their forecast.
Yes.
And what are those forecasts?
So it's likely the markets are saying November and probably March next year is when the markets are kind of saying it's likely there is going to be the next rate cuts as we go further forward.
Yeah. And look, there's no chance of a move at the next meeting. The RBA has shown that they want to see the quarterly CPI.
Yes.
So November is the next chance for them to move. But after that, all bets are off in terms of timing, because we will have a monthly CPI.
I was going to ask you about that question. We had the chief statistician on here, Martin Greenwood, last week, talking about that new CPI on a monthly basis. So just explain, will that change the way in which the Reserve Bank can view inflation, can therefore make decisions about interest rates? Is that really what the Treasurer Jim Chalmers was wanting to do when he was actually giving the finance to actually fund that new statistic?
Yeah, well, I think it is. I mean, we know that the monthly CPIs that we've had for the last few years, the RBA has downplayed it because it's not complete and it's different each month. So they've sort of parked it. And of course, the decision not to cut last time very much, again, reflected they don't really want to rely on the monthly numbers. They want to wait for the full quarterly, but they won't have that reasoning anymore because every month it will be a full CPI.
Yes.
So that means every 6 weeks when they meet, they will have all the information up to date on inflation. There'll be no reason to wait. And that was exactly what the governor said and the minutes said after the last meeting, that we considered a rate cut, but we thought we would just wait for the more information, i.e. the quarterly CPI.
Okay, so then just one other thing about this. The interest rate cuts that are coming, there's 2, 3, including tomorrow's. One thing about that, is that enough to get Australia's economic growth going again? We know there's this productivity and economic roundtable that the government's got. We know that the Prime Minister in particular has basically parked that because he says, look, it's an ideas thing, it's not what we're going to do. My gut feel is Australia's economy is growing at less than 1% on an annualised basis right now. Economic growth in Australia right now would fix a lot of things. Is the interest rate cuts enough to get things going again?
Well, they will get some parts of the economy going. We're seeing that they're already having an effect on housing markets and that the turnover there and prices are starting to etch up. They will free up cash flow. But look, the reason our economy can't grow anything like it used to is because our productivity is in trouble.
All right, so give me the one small piece of low-hanging fruit, the easiest thing that government could do to improve productivity, or is the reality that everything's too hard?
Well, politically, I think we're going to find out everything's too hard, but they could do what the Productivity Commission suggested and cut the company tax rate immediately.
They're not going to do that.
Well, they're not going to do it because they need the money. Another thing they could do is start to look at more flexible labour market. They could provide incentives for investing in new technology.
Sure.
But these are all going to cost
the very first thing you said, they're not going to do that because the government needs the money. The government, you could argue, is way too big. And the reality is that they're fundamentally one of the things holding back productivity.
They are. And they're a bigger player in the allocation of jobs than we've ever seen in Australia's history.
So more than 50% of jobs now rely on a government policy or the government directly, state or federal, for their income.
Well, that was one piece of analysis. Another one is the data from the ABS, which shows 30% of jobs are government funded directly, and then 50% of people are reliant on government through other payments as well. That's the problem, is that the government allocation of labour resources is not necessarily the most effective. We have had an economy for the last 40 years where the private sector, business and other organisations determine where the next job comes from, and it's usually reflection of productivity. So until we get our labour market more flexible, until we pull government back, I think our productivity story is not going to go away.
Warren Hogan, always good to chat to you. We'll do it again very, very shortly.
Thanks, Ross.